Paul Cavey, thanks very much indeed for joining us.
Give the government some confidence. Think about the economy more broadly going well for China. And the more interesting stories, you look at TSMC.
Hello, welcome to the East Asia Econ YouTube channel. I'm Paul Cavey, I'm the founder of East Asia Econ. And today I'm going to talk to you about stabilization in China and the macro implications of that and the reasons why it's happening. Now, I'll get on to that. First of all, I have a bit of 3 requests I wanted to make of anybody watching this video. So the first thing is, if you like the video, you find it interesting, then please do like the video and also subscribe to the service. It would help me a lot. And also, if you do like it, and frankly, even if you don't, you can recommend it to anybody else you would know. That would help me a lot. The second thing is to check out our website, eastasiaecon.com. On there, you'll find a wealth of information about the region. We have analysis, there's a bunch of data, there's also some visualizations where in particular you can look at what's happening with China's trade flows, which are increasingly important as a global issue. So that's something else to be looking at. The third thing is, if you like the video and you find it interesting, and also if you find things on the website that you think are useful, then please do think about becoming a paid subscriber. This is what I do for a living. So we have a service for individuals and also a service, a more comprehensive offering for financial institutions. And particularly if you're interested in the latter, then please get in touch with me directly at paul@eastasiaecon.com, and I can tell you more about what we do. So that's all by way of introduction and advertisement. So with that, on with the show. And as I said today, what I would talk about is China and the idea that there can be macro stabilization in China's economy. And to do that, basically the core argument here is that China in 2020 to 2021 experienced 2 big macroeconomic shocks. One was the property market related to the government's policy of the 3 red lines. And then the impact of that was exacerbated by the government's sort of economic chaos, really, that was caused by the zero COVID policy and the big impact that that had on consumer confidence in particular. So both of these things are akin to structural shocks to the economy. And I think what's happening now is there's signs that finally the economy is beginning to absorb those shocks. It's starting to get over the impact of those things that happened. And today what I'm going to talk about is really focus on some of the reasons for that and the things we can identify, and then think about the implications. And the implications are quite broad because one of the big consequences of the economic problems that China has had is deflation. And one of the implications of exiting these problems is that deflation starts to go away. So that matters for the equity market because it's something that boosts profitability of companies. And in fact, we can start to see some evidence of that in the economic data that's being produced in China. If deflation is ending, it means that there's less downwards pressure on interest rates. So that matters for what's happening with government bonds. And the third thing is it matters for the currency, because one of the big arguments against CNY appreciation sort of since 2021-22 is because monetary policy was easing, the Fed was hiking, interest rate differentials are bad for the currency. That whole argument now starts to look much weaker. So if the economy is stabilizing, and I would argue it is, it has big implications for how markets would react. So today, in terms of the structure of what I want to talk about, the first thing is to identify what the signs of stabilization in the economy are. The second thing is to kind of give a rationale of why this might be happening. And so in addition to that kind of broad argument that there's been a structural downturn, which is now sort of reaching a floor, I think we can pick out 5 other things that are important in determining or driving this recovery in the economy that we're seeing. And the third thing is to talk in a bit more detail about both the risks around this and also what the implications might be. So that's the kind of 3 sections in terms of what I'm going to talk about today. So the first thing is to think about these, what are the signs of stabilization? How can we argue this is happening? And I think there's a few things I would highlight. So the first thing is there is a stabilization in this chart. So this shows the ratio of demand deposits relative to time deposits for the household sector in China. Now, what does this show, right? It's a way of thinking about where households want to leave their money. And sort of intuitively, if you're leaving your money more in time deposits, it sort of means you don't want to use that money, right? You're locking it up. You might see there's higher interest rates, but you're certainly not really wanting to do anything with that money. And so when you tend to see this line falling, as it was consistently until sort of the early part of 2025, it's usually a sign that it's deflationary for China's economy. As it starts to stabilize then, and implying that people are moving less money in time deposits, they're starting to have money in current account deposits, if you like. As that starts to happen, it tends to be something that's inflation-free for the economy. So I think more than anything else is one of the things really to be keeping in mind when thinking about whether there is indeed a stabilization in the economy. And this does make it look like after a multi-year decline, there is now finally some change. The second thing, what's happening with the property market? And this remains like very tentative, and it's not at all to say that somehow the property market in China is looking much better and a recovery is happening. But I think what is apparent is that the data, the collapse in property activity that happened after 2021 is now beginning to sort of reach a floor. And the very easy way to understand that is because if you look at this chart, for example, property starts in China over the course of the last 5 years or so, they're down by like 80% from the peak. Now, obviously, it's unlikely that property starts are going to get to zero. So it seems to get it. And so this kind of tentative bottoming out of both property starts and in particular property sales, like it basically suggests that most of the process is now done. That in some way there's been like an excessive correction that's happening extremely quickly over the course of the last 3 to 4 years, and that negative hit on the economy coming from this contraction is now beginning to ease. So first thing is time to demand deposits. The second thing is what's happening in the property market. The third thing is this chart, which is PPI inflation in China. Now, what's happened recently is because of the energy price shock that suddenly prices have started to rise, and so PPI rising sort of 2-ish% year on year and positive for the first time since 2022. Now, that increase, a lot of it's due to energy, which actually isn't something that's positive for China's economy. However, I think it's important to remember that actually the decline in PPI in level terms, so the level of prices, that stopped falling in about sort of May, June time 2025. So a long time before anything happened in Iran. So I think there's more fundamental reasons to explain why prices have now stopped falling, even if some of the kind of the icing on the cake, if you like, from an inflation perspective, is really because of what's happening with energy prices. So we've got time to demand deposits, property market, and the third thing now is thinking about this stabilization of prices. A fourth thing is what's happening with consumer confidence, as this chart suggests. Now, again, this is kind of a useful chart in a couple of ways, right? Because one, it shows still how bad things are. None of the things I'm talking about here are saying that suddenly China's economy is off to the races, that there is a big recovery underway in China. I don't really see any evidence for that. However, what we do see is a modest recovery in consumer confidence that's been going since sort of 2024 or so. Now, I think that sort of stands out because there's no real obvious policy trigger for this, right? Like the government hasn't done anything for the consumer sector in an aggressive way over the course of the last couple of years or so. And so the fact that consumer confidence is creeping up is something which I think is a second derivative improvement. It's not something, again, that suggests big recovery, but it is something that suggests the economy is no longer getting much worse. A couple of other things to mention. This chart looks at long-term yields in China, where again they've stopped falling. I made an argument sort of about 18 months ago, looking at the experience of Japan, that actually there was good reasons to think that yields should be bottoming in China. I think that's something that started to happen. And the final thing, which is sort of in more recent data, is that we are now starting to see profitability in China starting to rise on the back of the improvement in PPI. And again, so it's this kind of nominal improvement in the economy, which is starting to have sort of broader repercussions. So those are all the kind of the 6 or 7 reasons I'll be going through to think about, why we can argue that there is a stabilization of macro in China happening. Now, that's the first part. The second part then is to think about what the reasons for this are, like why this might be happening. it's not Japan. And so even like very recently, the FT had an article like looking at the experience of Japan. Sorry, The Economist had an article looking at the experience of Japan and saying that, you know, like what can China learn from Japan in terms of the exit from deflation? Now, that article, to my mind, missed a huge issue, which is the exchange rate. And I've talked about this a lot over, you know, different videos and a lot of the analysis we've done. There's a huge difference between China today and Japan back in the 1990s, and that is the exchange rate. And the kind of the best way of showing that is between 1990 and 1995. So when the bubble in Japan had already popped, the stock market was falling, PPI was already in deflation. The Japanese yen in both nominal and real terms appreciated by 60 to 70%. That's important because the economy in Japan in 1990 was already expensive relative to the rest of the world. And as this chart shows, which is a chart reproduced from a BOJ report that was issued a couple of years ago, looking at the experience of Japan, the deflation experience of Japan, the starting point for Japan in 1995, partly as a result of this appreciation of the currency, was that Japan was hugely expensive relative to the rest of the world. So why was there deflation in Japan? Why was there what was the sort of fundamental reason for prices falling for so long? In a way, it was just because Japan was a very expensive economy and therefore needed to get cheaper relative to the rest of the world in order to be able to regain competitiveness and so on. Now, if we take that same framework and apply it to China today, you can see that it's just completely different. It's completely different in two ways. So one, as this chart shows, looking at that price differential argument, like China is not expensive relative to the rest of the world in 2020. It wasn't an expensive economy then. And since 2020, even though there has been deflation, which arguably should be pushing up real interest rates and therefore pushing up the exchange rate, even though those things have been in place, the currency hasn't appreciated. Instead, the currency has weakened. So I think as a starting point, I'd be very skeptical that deflation in China would continue indefinitely, that there was some kind of deflationary spiral that China was caught in because the currency was behaving in a very different way to what you would expect if real interest rates were rising, because that's something that generally tends to attract money in and push the currency up even further. That's something that didn't happen in China. So that's one difference and one reason for thinking that the economy can recover. The second thing is this argument that basically it's all just time and this kind of remarkable collapse in property market activity that's happened over the course of the last 4 years or so is basically enough. So property starts again down 80% from the peak. Like it just becomes very unlikely that they continue to fall as quickly as they have done in the past because most of the correction has now been done. And so I think from a simple sort of point of view, that it makes a lot of sense that we're very much, certainly closer to the end of the correction in property construction than we are to the beginning. Now, I think you can argue about prices and whether prices need to fall further and so on. And I think that is an important question, but it's a different question. But in terms of construction, which has had, the fall in construction had a big impact on PPI inflation and a big impact on activity in the economy, like I think it starts to become reasonable to think that most of the correction is now done, and therefore the rate of contraction that happens from here is going to be smaller than it has been in the past. So that's the second thing. The third thing, again, is this idea about money velocity. And so thinking about the time demand deposit ratio in the household sector. So again, that fell for many years. Over the course of the last, few months or so, there has been some stabilization. And to my mind, this stabilization means, like intuitively, I think it suggests that households are becoming less bearish about the future. It's not to say they're becoming a bit like the consumer confidence number, right? Like it's not they're becoming much more confident, but there is a second derivative improvement. They're becoming less bearish about things going forward than they were previously. Now, in a bit earlier in the video, I talked about, showed the chart of time to deposit ratios. The other way you could show the chart is this, which is looking at the change in the time to deposit household ratio against inflation. And this, I think, is this intuitive point that usually when households start to move less money into time deposits, you tend to see inflation in the economy beginning to rebound. And here I use inflation on sort of a broad basis, right? So it's PPI, CPI, house prices, and what's happening with the equity market. And so again, when you think, certainly what's happening in Iran and the impact of energy prices on China's economy is something that's pushing up inflation. Like, actually, I think there's other reasons why inflation has begun to stabilize in China beyond what's happening with Iran. And it's a bit more fundamental to the stabilization of the economy that started to happen. The fourth thing, and this relates to the weakness of the currency that China has managed to engineer since 2021 in particular, and that is what's happening with exports. Again, unlike Japan back in the 1990s in particular, export growth in China has been very strong in particular in volume terms over the course of the last 18 months or so. Now, this has a bunch of different drivers. I think the currency is one of them, the fact that the currency remains cheap, the fact that the cost of production in China is cheap, but also other things are playing a role. Industrial policy that China has, the fact that there hasn't been a boost in terms of consumption, the fact that growth domestically is weak and that reduces demand for imports and so on. So all of these things are playing a role. Whatever it is, the end result of that is that export growth has been very strong. Now, again, this is something that, from China's perspective, helps to stabilize the rest of the economy when domestic demand has been a mess. It's probably not something that's particularly helpful for the rest of the world. I mean, different ways of looking at this, but certainly from a macro perspective, and we can see it in Europe where, the authorities are very concerned about the amount of exports that are coming from China. But from China's perspective, it is something that stabilizes the economy in a way that wouldn't be happening otherwise. So again, this is another reason why, and again, compared with Japan, that it is reasonable to think that China's economy could be stabilizing here. Now, there's just a couple of other things to talk about. So one is capital flows. And again, it's a bit related to the currency. It's related to some of the other things we've been talking about. So in an environment where there's deflation, in that environment, the central bank is trying to cut interest rates because it doesn't want policy to be too tight. Now, when the rest of the world is hiking interest rates, that's a problem for the currency because it means that the currency tends to weaken and you tend to see capital outflows from China happening. And so this is something which forces money to leave the economy. So as inflation has started to stabilize in China, the rate of policy easing from the central bank has fallen. And so I have an indicator that's been suggesting really for the last 9 months that the risk of further easing in China has been declining. And as interest rates stop falling, that's something that seems to be feeding into both a stabilization of the currency, but also a re-acceleration of capital inflows back into China. And so that stabilization of the currency and the lack of easing is actually something that then, again, is supportive of the currency stabilizing. And that leads to kind of the sixth point on this, that until now, the data is a bit iffy because these days it's difficult to count exactly how many reserves the Central Bank of China has. And so when we think about sort of balance sheet expansion, which you would look at in other economies, the data in China is probably not as clean as it would be elsewhere. But I think the point still holds. And if you look at this chart, basically it shows that the balance sheet of the PBC hasn't been doing very much on an aggregate basis over the course of the last 3 to 4 years or so. There definitely has been a big increase in PBC lending to the financial sector. So there has been an easing happening in this sense, but it hasn't been happening through a general increase in the size of the balance sheet. Now, if you start to see capital inflows coming back into China, which we have seen in the recent data related to the stabilization of the currency, then we should expect to see a bit more balance sheet expansion. And again, I think this is something that then reinforces the kind of stabilization and tentative reflation of the economy that now starts to happen. So I've gone through like a bunch of different reasons, right? So the first thing is trying to identify indicators that would suggest the economy is stabilizing. The second is to talk about that in a bit more detail. And there's 6, I think, drivers that we can point to and as why it is reasonable to think the economy should be stabilizing here. Now, particularly in terms of that consumer confidence survey, like you might look at it and laugh because the numbers still are extremely weak and you might think it doesn't mean anything. And I would say, like in all of this, like I don't really have a a good argument that somehow China's economy is getting a ton better. And so, like, it's certainly easy to think about all of the risks that still apply, like the property market still is extremely weak. If we look at mortgage lending, for example, and household lending from the banking sector, that all still looks extremely weak. Consumer spending in terms of the retail sales numbers, industrial production, these kind of things, like they all, in the latest releases also look very weak. And the economy still continues to lean heavily on exports. So it's not like that there's a smoking gun saying the economy suddenly is getting a whole lot better. That's not the argument I'm making. I'm making an argument that there is a second derivative improvement. And second derivative improvement in market sense, I think, is something that is notable. It is something that is important for understanding how markets will trade some of the stuff that's happening in China today. And what are the implications of that? So I think if we think about the different markets, so thinking about equities, interest rates, and the currency, if we think about equities, it's probably where things look strongest. And the reason for saying that is because if you're the PBC, you probably think right now that actually a bit, certainly helpful to have some currency appreciation because energy prices are rising and import prices are going up. But you want to be very careful about how much appreciation happens because you don't want to over-tighten the economy. And I think what that means is the balance in terms of capital inflows versus the currency, and in a way you can have one or two of those two things. I think the authorities would rather have the capital inflows and the balance sheet expansion because they're intervening to prevent the currency from appreciating too much, rather than have too much currency appreciation. And if that's right, that's something that should be positive for the equity market. The second thing then is what it means for interest rates. And again, this idea that this is very early in a stabilization, there isn't really a lot of recovery yet. It would suggest that interest rates probably stabilize, but it's not suggesting that interest rates are going to be going up a lot. And if you look at the rest of the region, I certainly see good arguments for thinking that interest rates elsewhere will be rising. I see it's not really clear that China is in that position right now. And then the third thing, what's the implications for the currency? The currency, I mean, certainly compared with 3 or 4 months ago, it would look like the PBC is probably going to be more tolerant of exchange rate appreciation because it helps to diffuse for the domestic economy the impact of energy prices rising overseas. But again, it's not something where the currency is going to move a lot when the economy remains still in this sort of recovering but still not very strong state. So, talk today a bit about what's happening in China. My argument, I think the economy is stabilizing. I think that has some important macro implications. I think there's good reasons for making that argument, even if the evidence still is a bit tentative. If you want to understand this more and get more background on what's going on, then please check out the other videos that we've made. Also look at the website, eastasiaecon.com, and get in touch if you have any questions. Thanks very much for watching.